This isn't going to be your typical personal finance book. I'm not here to sugarcoat anything or tell you that everything's going to be okay if you just work a little harder at your 9 to 5. No. This book is about the truth, the uncomfortable, frustrating, sometimes infuriating truth about why so many of us who played by the rules ended up broke. I'm talking about the straight-A students, the valedictorians, the ones who memorized every formula, aced every test, and walked across that graduation stage with honors cords draped around their necks and absolutely zero idea how money actually works. Meanwhile, the kid who barely graduated, the one who spent more time starting businesses in the school parking lot than sitting in class, that kid now drives a better car than their former teachers. How does that happen? That's what we're here to figure out. Chapter 1. The Debt Trap. Part 1. The Promise. Let me tell you about Sarah, straight-A student, top of her class, got into a prestigious university to study engineering. Her parents threw her a graduation party. Her teachers wrote glowing recommendation letters. Everyone told her she was going places, and she believed them. Why wouldn't she? She'd done everything right. She studied hard. She followed the rules. She was told that education was the key to success, and she had the grades to prove she'd mastered it. So when it came time to sign those student loan papers, Sarah didn't hesitate. $60,000 in loans. That number seemed abstract at 18 years old. A future problem. Something she'd deal with after she got that high-paying engineering job everyone kept talking about. 4 years later, Sarah graduated. Magna cum laude. She had the degree. She had the credentials. She had $72,000 in debt, because loans have this funny way of growing while you're busy studying. The job she got paid $55,000 a year. Sounds decent, right? Until you realize that after taxes, rent, food, and her loan payments, Sarah was living paycheck to paycheck, just like the people who didn't go to college at all. But here's the thing that really hurt. Sarah's loan payments, they were going almost entirely to interest. She was paying nearly $600 a month, and barely $100 of that touched the principal. At this rate, she'd be paying off these loans into her 40s. She did the math one night. By the time she actually paid off her student loans, she would have paid over $110,000 for a $60,000 education. That's not education. That's a scam. Part 2. The system. Now, before you think this is just about Sarah being unlucky or making bad choices, let me be clear. This is about the system. This is about how we've been sold a lie, packaged as the American dream. Here's what nobody tells you in high school. The education system wasn't designed to make you wealthy. It was designed to make you employable. There's a huge difference. Think about it. What do you learn in school? You learn to show up on time, to sit still for 8 hours, to follow instructions, to ask permission to use the bathroom, to accept that someone else decides when you eat, when you rest, and what you should know. You're being trained to be an employee, not an owner, not an investor, an employee. And that's fine if that's what you want. But nobody asks you what you want. They just funnel you through the system and hand you a bill at the end. The really crazy part? We call the most obedient students successful, the ones who memorize what they're told and regurgitate it on command, the ones who never question why they're learning quadratic equations but nothing about compound interest. You know what we call the students who question the system? Troublemakers. Unfocused, not college material. Meanwhile, those troublemakers are out there starting businesses, learning through experience, and making real money while the honor students are drowning in debt. Part 3. The Wake-Up Call. I remember the moment I realized I'd been scammed. I was sitting in my cubicle looking at my paycheck. I'd just gotten my generous 3% raise. I did the math. After taxes, that was an extra $47 per paycheck. I'd spent 4 years in college, taken on $40,000 in debt, spent countless nights studying, for an extra $47 every 2 weeks. And my boss? The guy who decided I deserved that 3%. He had a C average in college. He told me that in my interview, actually. Said college was just something his parents made him do, while he was really learning business from his uncle's construction company. That construction company was now worth millions. My boss drove a Tesla. I drove a 12-year-old Honda and brought leftovers for lunch to save money. Something was very, very wrong with this picture. So I started asking questions. Not the kind of questions they teach you to ask in school. Different questions. Uncomfortable questions. Why was I trading my time for money instead of making money work for me? Why did I know calculus but not how taxes worked? Why could I write a 20-page research paper but not create a simple business plan? Why had I spent 16 years in the education system and nobody had ever taught me about assets versus liabilities? The more questions I asked, the angrier I got, because the answers were all the same. Nobody taught you this stuff because if they did, you wouldn't need them anymore. Chapter 2. The Truth About Education. 1. History Lesson. Let's talk about where our education system actually came from, because understanding this will help you understand why it fails so spectacularly at creating wealthy people. The modern American education system was largely modeled after the Prussian system from the 1800s. And what was the goal of the Prussian system? To create obedient soldiers and factory workers, not entrepreneurs, not investors, not free-thinking wealthy individuals, soldiers and factory workers. The system was designed to take unique individuals and turn them into standardized parts that could be plugged into the industrial machine. Show up on time, follow orders, don't ask too many questions, retire at 65. And it worked brilliantly for the factory owners. Now here's the thing. We don't have that many factories anymore. The industrial age ended, but the education system, that stayed exactly the same. We're still teaching kids to memorize and regurgitate, to sit still for hours, to beg for permission, to accept that one person gets to decide what everyone learns and when they learn it. We're preparing kids for a world that doesn't exist anymore. A world where you could graduate high school, get a job at the factory, and work there for 40 years until you retired with a pension. That world is gone, but the education system acts like it's still here. Part 2. What school actually teaches. Let me break down what you actually learn in school versus what you need to know to build wealth. In school, you learn that there's one right answer to every question. The teacher has it. Your job is to figure out what the teacher wants to hear and repeat it back. In the real world of wealth building, there are no right answers. There are only results. You have to think for yourself. You have to solve problems that have never been solved before. You have to create value where none existed. In school, you learn that failure is bad. Get an F and you're in trouble. Fail a class and you might not graduate. Failure is something to be avoided at all costs. In the real world of business and investing, failure is education. Every successful entrepreneur has failed multiple times. Every wealthy investor has made bad investments. Failure is how you learn what works. In school, you learn to work alone. Collaboration is called cheating. You're supposed to figure everything out by yourself and prove that you're smart enough to do it. In the real world, the wealthiest people are masters of collaboration. They build teams. They delegate. They understand that you get rich by leveraging other people's time, money, and expertise. In school, you learn that knowledge is power. Get good grades, show everyone how smart you are, and success will follow. In the real world, execution is power. I know plenty of people with PhDs who are broke. I know plenty of high school dropouts who are millionaires. Knowledge without action is just trivia. Part 3. The subjects they don't teach. Here's what really gets me. We spend 12 years, minimum, in the education system. 12 years. And in all that time, here's what they don't teach you. How to file taxes. How the tax code actually works. Why wealthy people pay less in taxes than middle-class people, and how they do it legally. How to invest. What stocks actually are, how bonds work, what real estate investing looks like, the difference between speculation and investing, how to start a business, how to identify a market need, how to create value, how to scale operations, how to hire people, how to fire people, how to negotiate, how to ask for more money, how to structure a deal, how to walk away when something doesn't serve you, how money actually works, where it comes from, why inflation exists, how the Federal Reserve affects your purchasing power, why your savings account loses value while you sleep, how debt can be used as a tool, when to borrow money, when to avoid debt, why rich people use debt strategically while poor people drown in it, how to read a financial statement, how to understand cash flow, how to tell if a business is actually profitable or just looks profitable. Instead, you learn about the Pythagorean theorem, you memorize the periodic table, you study novels written 200 years ago by dead Europeans. Now, I'm not saying those things have no value. Education has value. Learning has value. But when you graduate and realize you have no idea how to build wealth, that's a problem. When you spend 4 years getting a degree and still don't know the difference between an asset and a liability, that's a scam. Chapter 3. The C-Student Advantage. Part 1. Different rules. Here's something that's going to upset some people, but it needs to be said. C students often become more financially successful than A students. Not always, but often enough that we need to talk about why. It's not because C students are smarter, it's not because they work harder, it's because they play by different rules. See, A students are really good at the game of school. They've mastered it. They know exactly how to make teachers happy. They know how to study for tests. They know how to write papers that get good grades. But here's the problem. Making teachers happy doesn't make you rich. Acing tests doesn't build wealth. Writing papers doesn't create cash flow. C students, on the other hand, they never really bought into the game. They did the minimum required to get through. And while the A students were pulling all-nighters to memorize information they'd forget in a week, the C students were doing other things. Some of them were starting small businesses, selling things at school, fixing cars, building websites, learning real skills that actually made money. Some of them were networking, building relationships, learning how to talk to people, persuade people, work with people, skills that you can't learn from a textbook. Some of them were questioning everything. Why do we have to learn this? Why do things work this way? What if we did it differently? Questions that annoyed their teachers but trained them to think independently. Part 2. Risk and Reward. Let me tell you about my friend Marcus, solid C student. His teachers were always on his case about applying himself more. His parents worried he wouldn't amount to anything. Marcus wasn't stupid. He just wasn't interested in school. You know, what he was interested in? Sneakers. Starting in sophomore year of high school, Marcus figured out that he could buy limited edition sneakers when they dropped and resell them for profit. Not a lot of profit at first, $20 here, $30 there. But Marcus treated it like a business. He studied market trends. He learned which brands held value. He built relationships with other resellers. He saved his profits and reinvested them into buying more inventory. By senior year, while everyone else was stressing about AP exams, Marcus was making $2,000 a month flipping sneakers. He skipped college. His parents nearly had a heart attack. 5 years later, Marcus owns an e-commerce business doing 7 figures annually. He employs 12 people. He owns 2 rental properties. He's 23 years old. Meanwhile, his classmates who got straight A's are working entry-level jobs and complaining about their student loans. What did Marcus have that they didn't? He understood risk. A students are trained to avoid risk, don't take chances, color inside the lines, follow the proven path, take the safe option. But wealth is built through calculated risk. Investing is risk. Starting a business is risk. Real estate is risk. Everything that builds wealth involves putting something on the line with no guarantee of success. C students are more comfortable with risk because they've been taking risks all along. They risked getting bad grades. They risked disappointing people. They risked being seen as failures. And in doing so, they learned something crucial. Failure isn't fatal. You can take a risk, fail, and survive. And when you survive, you learn. And when you learn, you get better. Part 3, the employee mindset. Here's the hardest truth in this book. School trains you to be an employee. everything about it. You learn to show up when you're told. You learn to ask permission. You learn that someone else sets your schedule. You learn that you get rewarded for obedience and punished for thinking outside the box. You learn to trade time for grades. Show up for enough hours, complete enough assignments, and you get your grade. It doesn't matter if you're passionate about it. It doesn't matter if it's meaningful to you. Just put in the time and get your reward. Sound familiar? That's exactly how employment works. Show up for enough hours, complete enough tasks, and you get your paycheck. Passion optional. Meaning optional. Just put in the time. A students excel at this game. They're the best employees. They follow instructions perfectly. They meet deadlines. They don't cause trouble. Employers love them. But here's the thing about being an employee. There's a ceiling. Sure, you can climb the corporate ladder, you can get promotions and raises, but you're always trading time for money, and there are only so many hours in a day. You know who doesn't have a ceiling? Business owners, investors, people who understand how to make money work for them, instead of working for money. And C students? They're more likely to think like owners because school never convinced them that being a good employee was the ultimate goal. Chapter 4. Financial Literacy. 101, Part 1, Assets versus Liabilities. All right, let's get into the actual education you should have received. We're going to start with the most fundamental concept in wealth building, and it's so simple, it's going to make you angry that nobody taught you this in school. Assets versus liabilities. Robert Kiyosaki, the author of Rich Dad, Poor Dad, has the simplest definition. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. That's it. That's the whole definition. But understanding this difference is the foundation of wealth. Let's start with what most people think is their biggest asset, their house. You bought a house. You own property. That's an asset, right? Wrong. For most people, their house is a liability. I know that sounds crazy. But let's think about it. Does your house put money in your pocket every month? No. It takes money out. Mortgage payment, property taxes, insurance, maintenance, utilities. Every month, your house costs you money. That's a liability. Now, if you bought a second house and rented it out, and the rent you collected was more than your mortgage payment and expenses, that rental property would be an asset. Because it puts money in your pocket every month. Same object, house. But one is an asset and one is a liability. The difference is the cash flow. Let's try another one. Your car. Asset or liability? For most people? Liability. Car payment, insurance, gas, maintenance, registration. Every month your car costs you money. But what if you drove for Uber and made more money from the car than it cost to own and operate? Now it's an asset. Here's another one that people get wrong. Your college degree. You spent tens of thousands of dollars on it. You worked hard for it. Surely that's an asset. Well, let's apply the definition. Does your degree put money in your pocket? Or does it take money out? If you're making loan payments every month, your degree is currently a liability. It might help you earn income, but the degree itself is taking money out of your pocket. This is the mindset shift you need to make. Wealthy people focus on acquiring assets, things that generate cash flow, things that make money while they sleep. Poor and middle-class people focus on acquiring liabilities, things that cost money to own, things that look impressive but drain their bank accounts. Part 2, Good Debt versus Bad Debt. Now let's talk about something that will probably blow your mind if you've been taught that all debt is bad. There's good debt and bad debt, and wealthy people understand the difference. Bad debt is debt you use to buy liabilities, credit card debt for clothes and restaurants, car loans for vehicles that depreciate, student loans for degrees that don't increase your earning power. These are all bad debt because you're borrowing money to buy things that take money out of your pocket. You're paying interest to own things that cost you more money. That's a double negative. You're going backwards financially. Good debt is debt you use to buy assets, things that generate more cash flow than the debt costs. Let me give you an example. Let's say you find a rental property. The house costs $200,000. You could put down 20%, which is $40,000, and get a mortgage for the rest. Your mortgage payment, plus taxes and insurance, costs you $1,200 a month. But you can rent the property for $1,600 a month. You're generating $400 a month in positive cash flow. That's $4,800 a year. On a $40,000 investment, that's a 12% annual return, not even counting the appreciation of the property or the equity you're building as the tenants pay down your mortgage. That debt? That's good debt. You borrowed money to buy something that makes you money. The debt pays for itself, and then some. Here's what wealthy people understand. Debt is a tool. Like any tool, it can be used well or poorly. A hammer can build a house or smash your thumb. It depends on how you use it. Poor people use debt to look rich. They finance cars they can't afford. They put vacations on credit cards. They buy big houses to impress people who don't care about them. Rich people use debt to become rich. They leverage other people's money to buy assets that generate cash flow. Part 3. The tax game. Let's talk about taxes, because this is where the education system really fails you. Most people think taxes are simple. You earn money. The government takes a percentage. That's just how it works. And if you're an employee, that is pretty much how it works. Your employer withholds taxes from every paycheck. You file your return at the end of the year. Maybe you get a small refund, done. But that's not how wealthy people experience taxes. Here's what you need to understand. The tax code isn't designed to be fair. It's designed to incentivize certain behaviors. The government wants people to invest in real estate, so they offer tax breaks for real estate investors. They want people to start businesses, so they offer tax breaks for business owners. They want people to invest in certain industries, so they offer tax credits. If you learn to do what the government wants to incentivize, you can dramatically reduce your tax burden. Legally. Completely legally. Let me give you an example. Let's say you're an employee making $70,000 a year. You're probably paying around 25% of that in federal and state income tax plus payroll taxes, so about $20,000 in taxes. Now let's say you're a business owner making $70,000 a year. You have a home office, so you can deduct a portion of your rent or mortgage. You drive for work, so you can deduct your mileage. You buy equipment for your business, so you can deduct that. You contribute to a retirement account, deductible. You have business meals, deductible. By the time you're done with legitimate business deductions, your taxable income might be $40,000 instead of $70,000. Now you're paying way less in taxes. Same income, different tax bill. The difference? Understanding how the game works. Or let's talk about real estate. When you own rental properties, you get something called depreciation. The IRS lets you deduct the theoretical decrease in value of the property over time, even though in reality the property is probably increasing in value. So you could have a rental property that generates cash flow every month, but on paper shows a loss due to depreciation. That paper loss reduces your taxable income. You're making money and paying less in taxes. This isn't cheating. This is the game. And the people who went to school, got good grades, and became employees, they're playing a different game where they can't win. Chapter 5. Self-Education. Part 1. Taking control. Okay. So if the traditional education system failed us, what do we do about it? Sit around and complain? Blame the system for our problems? No, we educate ourselves. Self-education isn't just reading books and watching videos, though that's part of it. Self-education is taking complete responsibility for what you know and what you don't know. Nobody is going to save you. Your employer isn't going to save you. The government isn't going to save you. Your parents can't save you, even if they want to. You have to save yourself. And the way you do that is by learning what you need to learn to get where you want to go. Here's the good news. We live in the greatest time in human history to learn anything. You have the internet, you have books, you have podcasts, you have online courses, you have YouTube channels where successful people share exactly what they did. Most of this information is free or cheap. The biggest investment isn't money, it's time and attention. And here's what makes self-education different from traditional education. You get to choose what to learn based on what actually serves your goals, not what someone else decided you should know, what you need to know. Want to learn about real estate investing? There are hundreds of books and courses. Want to learn about stocks, options, cryptocurrencies, business, sales, marketing? It's all out there. The education you need exists. You just have to go get it. Part 2. Building real skills. Let me tell you what skills actually matter in building wealth. These are the skills you should be focusing on instead of worrying about grades and degrees. First, sales. Everything is sales. If you can't sell, you can't build wealth. You need to sell your ideas, sell your products, sell yourself in interviews, sell your vision to investors or partners. Most people think salespeople are sleazy. That's because most people can't sell and they resent people who can. But ethical sales is just about solving problems for people and communicating value clearly. Learn to sell. Take courses, read books, practice. This skill alone can make you wealthy. Second, marketing. How do you get attention in a noisy world? How do you communicate what you do? How do you build an audience? How do you create demand? Marketing is how small businesses compete with big corporations. It's how individuals build personal brands. It's how you get people to know, like, and trust you. Third, financial literacy. We've covered some of this already, but you need to go deep. Learn to read financial statements, understand balance sheets and income statements, know how to analyze investments, understand different asset classes. You don't need to be a CPA, but you need to understand money well enough to make smart decisions and have intelligent conversations with the people who work for you. Fourth, negotiation. Everything is negotiable. Your salary, your rent, the price of a car, the terms of a contract. But most people never negotiate because they were never taught how. Learn to negotiate. Practice small negotiations. Get comfortable with asking for what you want and being told no. Being good at negotiation can be worth hundreds of thousands of dollars over your lifetime. Fifth, people skills. Emotional intelligence, leadership, communication, conflict resolution, how to build teams, how to motivate people, how to handle difficult conversations. Wealthy people aren't solo operators. They build teams and networks. You can't do that without people skills. Notice what's not on this list? Calculus, European history, chemistry. Not saying those things aren't interesting or valuable in their own right, but they don't build wealth. Part 3. Learning by doing. Here's the thing about self-education. You can't just read books and watch videos. You have to actually do things. Knowledge without execution is useless, worse than useless actually, because it gives you the illusion that you're making progress when you're not. I know people who have read every investing book ever written and never bought a single investment. I know people who have taken every business course on the internet and never started a business. They're professional students. They're addicted to learning but terrified of doing. Don't be that person. Here's my rule. For every hour you spend learning something, spend at least an hour doing something related to it. Reading about real estate investing? Go tour some properties, talk to a real estate agent, run numbers on deals, make an offer, even if it doesn't get accepted. Do something. Learning about stocks? Open a brokerage account, buy one share of something, watch what happens, feel what it's like to have money at risk, learn from the experience. Want to start a business? Start something, anything. Sell something on Facebook. Marketplace. Offer a service on Fiverr. Create a product and list it on Etsy. Take action. You will make mistakes. Good. Mistakes are expensive lessons, but they're the lessons that stick. You'll learn more from one failed business than from 10 books about business. The goal isn't to avoid failure. The goal is to fail forward, make mistakes, learn from them, and get better. That's self-education in action. Chapter 6. Breaking Free. Part 1. The Escape Plan. All right, so you're starting to see how the game actually works. You understand that your education might have prepared you to be an employee, but not to be wealthy. You're learning about financial literacy. You're educating yourself. Now what? How do you actually escape the trap? First, you need to get real about where you are. Pull out your financial statements. How much do you make? How much do you spend? How much debt do you have? What interest rates are you paying? Most people avoid looking at this information because it's depressing. But you can't fix a problem you won't acknowledge. Write it all down. your income, your expenses, your assets, your liabilities. Get a clear picture of your financial reality. This is your starting point. Second, you need to cut the bleeding. Look at your expenses. How much of your money is going to liabilities? How much are you spending on things that don't make you money? This doesn't mean living like a monk, but it does mean being honest about what's actually important to you versus what you're buying, because you're supposed to or because everyone else is doing it. That new car payment? Do you really need it? Or could you drive something cheaper and invest the difference? That expensive apartment in the trendy neighborhood? Is it worth it? Or could you live somewhere cheaper while you build wealth? Every dollar you spend on liabilities is a dollar that can't be invested in assets. Make choices accordingly. Third, you need to increase your income. There are only two ways to improve your financial situation: spend less or make more. Ideally, do both. How do you make more money? You have options. You can ask for a raise at your current job. You can switch jobs for higher pay. You can develop skills that make you more valuable. You can start a side business. You can invest in assets that generate cash flow. Most people just accept whatever income they have and try to budget their way to wealth. That's incredibly slow and difficult. It's much more effective to focus on making more money. Part 2. Building your first assets. Let's talk about how to actually start building assets, even if you don't have much money. A lot of people think you need to be rich to invest. Not true. You need to invest to become rich. There's a difference. Let's start with the simplest form of investing, the stock market. You can open a brokerage account with $100. Seriously. Most brokerages have no minimum investment requirements anymore. Start with index funds. These are funds that own a little bit of everything in the stock market. They're diversified, low cost, and historically have returned about 10% per year on average over the long term. $100 invested in an index fund at 10% annual return becomes about $260 in 10 years. Not life-changing money, but it's a start. More importantly, you're learning. You're watching how the market moves. You're getting comfortable with having money invested. You're building the habits and mindset of an investor. Can't afford $100? Then your first priority is to cut expenses and increase income until you can. I don't care if it's $10 a month at first. Start somewhere. Next, let's talk about building a business. This is more work than investing in the stock market, but it has much higher upside. You don't need a big idea or a huge investment. You need to solve a problem for someone and get paid for it. What skills do you have? What do you know how to do? What problems do you see around you that need solving? I know a guy who started a business pressure washing driveways. Total startup costs, $300 for a used pressure washer. He charged $50 to $100 per driveway depending on size. Made $2,000 his first month working weekends. Is that glamorous? No. Is it going to make him a millionaire? Probably not by itself. But it's cash flow. It's a business. It's an asset that makes money. And here's the beautiful thing. Once you have one asset generating cash flow, you can use that money to buy more assets. That's how wealth compounds. Part 3. The long game. I need to be honest with you about something. This isn't a get-rich-quick scheme. Building real wealth takes time, usually years, sometimes decades, and that's exactly why most people don't do it. They want instant results. They want to feel rich now. So they buy things that make them look rich instead of things that make them actually rich. But here's what happens when you play the long game. Let's say you start investing $500 a month. That's money you're currently spending on car payments, eating out, subscriptions, whatever. You cut that stuff and invest it instead. Year 1, you have about $6,000 invested. Not impressive. You're still broke. Your friends are driving nicer cars and living in nicer apartments. It's tempting to give up. Year 5, you have about $40,000 invested, assuming average market returns. Now it's getting interesting. You have a cushion, you have options, you're not living paycheck to paycheck anymore. Year 10, you have about $100,000. That's real money. That's, I could take a year off work if I wanted to, money. That's, I can invest in opportunities money. That's freedom money. Year 20, you have over $400,000. You're wealthy. Not billionaire wealthy, but wealthier than most people will ever be. And you got there by investing $500 a month. That's the power of compound interest. That's the power of assets. That's the power of playing the long game while everyone else is playing the short game. Most people never do this because they can't delay gratification. They want to feel successful now, so they buy things that make them look successful instead of investing in things that make them actually successful. Don't be most people. Chapter 7. The Real Education. Part 1. Mentors and Models. One of the most valuable things you can do in your self-education journey is to find mentors, not teachers. Mentors. What's the difference? Teachers tell you what to do. Mentors show you how they did it. Teachers give you theory. Mentors give you reality. Teachers grade you. Mentors invest in you. Finding mentors isn't easy, especially if you're just starting out and don't have much to offer. But it's possible. Start by identifying people who have what you want. Who's doing what you want to do? Who's achieved what you want to achieve? You probably can't reach the absolute top people in any field, but you can probably reach people who are a few steps ahead of you. And that's actually better anyway, because they remember what it was like to be where you are. How do you approach potential mentors? Provide value first. Don't ask for their time. Don't ask them to teach you. Offer to help them with something. Work for free. Make yourself useful. Most successful people are looking for hungry, ambitious people to invest in. But they need to know you're serious. They need to know you'll actually execute on what they teach you. Show them you're serious by taking action. Show them results. Then ask for advice on how to get to the next level. And here's something important. Mentorship doesn't always look like formal meetings where someone sits you down and teaches you. Sometimes the best mentorship is just being around successful people and observing how they think and operate. How do they make decisions? How do they handle problems? How do they talk about money and risk and opportunity? You become like the people you spend time with. Choose carefully. Part 2. Books that changed everything. Let me give you a reading list. These are books that teach what school doesn't. If you read and actually apply what's in these books, your financial life will transform. Start with Rich Dad, Poor Dad by Robert Kiyosaki. This book breaks down assets versus liabilities, explains why the rich don't work for money, and challenges everything you were taught about financial security. It's simple and repetitive, but that's because the concepts are so different from what we were taught that they need to be repeated. Next, read The Millionaire Next Door by Thomas Stanley. This book destroys the myth of what wealthy people look like. Turns out most millionaires don't drive luxury cars or wear expensive clothes. They live below their means and invest the difference. It's not sexy, but it's real. Think and Grow Rich by Napoleon Hill. This is old, published in 1937, but the principles haven't changed. It's about mindset more than tactics. How do wealthy people think differently? What beliefs drive their behavior? This book breaks it down. The Intelligent Investor by Benjamin Graham. This is the Bible of value investing. It's dense and technical in parts, but it teaches you how to actually analyze investments instead of just gambling on hot stocks. Warren Buffett calls this the best book ever written on investing. The 4-Hour Workweek by Tim Ferriss. This book isn't really about working 4 hours per week. It's about questioning assumptions. Why do we work the way we work? Why do we wait until 65 to enjoy life? How can we design our lives differently? It'll make you think. The Lean Startup by Eric Rice. If you want to start a business, this book teaches you how to test ideas quickly and cheaply, instead of spending years and tons of money building something nobody wants. Tax-Free Wealth by Tom Wheelwright. This book explains how the tax code actually works and how to use it legally to reduce your taxes. It's not about cheating. It's about understanding the incentives built into the system. But here's the key. Don't just read these books. Study them. Take notes. Discuss them with other people. Most importantly, implement what you learn. One idea implemented is worth more than 100 ideas just read and forgotten. Part 3. Community and Network. Let me tell you something about wealth that nobody talks about. It's not built alone. Every wealthy person I know got there through relationships and networks. You need to surround yourself with people who are playing the same game you are. People who are investing, building businesses, learning about money, growing. If all your friends are broke and spending money on liabilities, guess what? You're going to stay broke too. Not because your friends are bad people, but because we're social creatures. We conform to the groups we're part of. You need to find your people. Where do you find them? Real estate investment clubs. These meet in most cities. People who own or rental properties get together to share deals, strategies, and lessons learned. Go to these meetings, listen, learn, network, entrepreneur meetups. Sites like meetup.com have groups for entrepreneurs and business owners. Go, talk to people, share what you're working on, ask questions, online communities. There are forums, Facebook groups, Discord servers full of people learning about investing and building wealth. Join these communities, participate, provide value, build relationships, masterminds. This is a small group, usually 5 to 10 people, who meet regularly to discuss their goals and hold each other accountable. If you can find or create a good mastermind group, it's incredibly valuable. The point is this: you cannot rely only on yourself. You need other people who understand what you're trying to do, people who can teach you, challenge you, hold you accountable, celebrate your wins, and help you through your losses. School taught you to compete with your classmates. Wealth is built by collaborating with your peers. Chapter 8, Advanced Strategies. Part 1, Leverage the Multiplier. Now we're going to talk about what separates the wealthy from the comfortable. Leverage. Leverage is using something external to multiply your results. There are different types of leverage, and wealthy people use all of them. First, there's financial leverage. This is using borrowed money to invest. We touched on this earlier with real estate, but let's go deeper. Let's say you have $50,000 to invest. You could buy $50,000 worth of stock. If the stock goes up 10%, you make $5,000. That's a 10% return on your money. Or you could use that $50,000 as a down payment on a $250,000 rental property. You borrow the other $200,000. If the property appreciates 10%, it's now worth $275,000. That's a $25,000 gain on your $50,000 investment. That's a 50% return. See the difference? Same appreciation rate, but leverage multiplied your returns. Now, leverage also multiplies risk. If the property value goes down 10%, you lose money faster too. That's why leverage needs to be used carefully and strategically. But avoiding leverage entirely? That's leaving money on the table. Second type of leverage, other people's time. This is building a business or team where other people work to generate value. When you're an employee, you can only work so many hours. Your income is capped by your time. But when you own a business with employees, their time generates income for you. You're leveraging their time. Same with investing. When you own stock in a company, you're leveraging the time and effort of everyone who works at that company. When you own rental properties, you're leveraging the work of property managers, contractors, and even your tenants who pay rent. Third type of leverage, technology and systems. This is creating something once that continues to generate value. Write a book. It generates royalties forever. Create an online course. It sells while you sleep. Build software. It serves customers automatically. Create content on YouTube. It generates ad revenue for years. This is the most powerful form of leverage because it scales infinitely with minimal additional work. The wealthy understand leverage. They're not just working hard. They're working smart by multiplying their efforts through money, people, and systems. Part 2. Tax optimization strategies. Let's get more specific about taxes because this is where you can save massive amounts of money if you know what you're doing. First strategy, start a business, even a side business, even a small business. The tax benefits are enormous. When you have a legitimate business, suddenly lots of expenses become deductible. Your home office, your internet, your phone, your computer, your car mileage, travel that's related to business, meals with clients or potential clients, professional development and education. These are expenses you're already paying, but now they reduce your taxable income. For someone in the 25% tax bracket, every $1,000 in deductions saves you $250 in taxes. Over a year, this can easily save you $5,000 to $10,000 or more in taxes. That's real money that stays in your pocket instead of going to the government. Second strategy, real estate depreciation. We mentioned this earlier, but it's so powerful it's worth repeating. When you own rental property, the IRS lets you depreciate the building over 27 and a half years. So if you buy a property where the building is worth $275,000, you can deduct $10,000 per year in depreciation. Even if your property is making money and increasing in value, that depreciation creates a paper loss that reduces your taxable income. This is completely legal and incredibly valuable. Some real estate investors make hundreds of thousands of dollars per year in rental income and pay almost nothing in income tax because of depreciation and other real estate tax benefits. Third strategy, retirement accounts. Max them out. 401ks, IRAs, Roth IRAs, SEP IRAs if you're self-employed. These accounts either give you a tax deduction now or let your money grow tax-free. Either way, you're paying less tax over your lifetime than if you just invested in a regular taxable account. Fourth strategy, capital gains tax rates. Long-term capital gains, which is profit from investments you held for more than a year, are taxed at a much lower rate than ordinary income. If you make $60,000 from your job, you might pay 25% in tax. If you make $60,000 from long-term capital gains, you might pay only 15% or even zero depending on your income level. This is why wealthy people focus on investments that generate capital gains rather than just earning more salary. The tax treatment is much more favorable. Fifth strategy, charitable giving. If you're charitably inclined anyway, structuring your giving properly can create tax benefits while doing good. Donating appreciated stock to charity, for example, lets you deduct the full current value without paying capital gains tax on the appreciation. Setting up a donor-advised fund can give you an immediate tax deduction while you decide over time which charities to support. I'm not a tax professional, and you should definitely work with a good CPA who understands these strategies. But the point is this: the tax code is full of legal ways to reduce your taxes. You just need to know they exist and structure your finances to take advantage of them. Part 3. Debt as a tool. Let's talk about the sophisticated use of debt. This is what separates wealthy people from everyone else. Most people use debt to buy things: cars, TVs, vacations, clothes. They're consuming on credit. This is the worst use of debt. Wealthy people use debt to buy assets that produce income. They're investing on credit. This is powerful when done correctly. Here's an example. Let's say you find a rental property that costs $300,000. You could save up $300,000 and buy it with cash. That's one way to do it. Or you could put down 20%, which is $60,000, and finance the rest. Now you control a $300,000 asset with only $60,000 of your own money. The rent covers your mortgage payment and expenses. You're generating cash flow. And you still have $240,000 that you didn't have to use. You can invest that money in other opportunities. This is how wealthy people scale. They use leverage to control more assets with less of their own capital. Then, they use the income from those assets to pay down the debt while also investing in more assets. Another sophisticated strategy: borrowing against your assets without selling them. Let's say you own stock that's increased in value. If you sell it, you pay capital gains tax. But if you borrow against it, using something called a securities-backed line of credit, you can access cash without selling and without triggering taxes. You can then use that borrowed money to invest in other opportunities. As long as your investments are generating returns higher than the interest rate on your loan, you're making money on borrowed funds. Real estate investors do this with something called cash-out refinancing. The property is appreciated in value, so they refinance at the higher value, pull cash out, and use it to buy more properties, all while keeping the original property generating income. Is this risky? It can be if you don't know what you're doing, but managed properly, using debt strategically is one of the most powerful wealth-building tools available. The key is this: never borrow money for things that don't generate a return, but be willing to borrow strategically for assets that produce income. Chapter 9. Building Your Empire. Part 1. From Side Hustle to Empire. Let's talk about the path from where you are now to actually wealthy. Because it's not one big jump, It's a series of steps. Step 1 is what we've been talking about. Get your financial house in order, cut expenses, eliminate bad debt, start investing, build your first assets. Step 2 is building a side business or income stream while you still have your job. This is crucial because it gives you runway. You're not betting everything on one idea. You're testing and learning while you still have security. Your side business might start small. A few $100s a month, then $1,000, then $2,000. At some point, it might match your job income. That's when you have a decision to make. Do you keep the job and bank all the side income? Or do you quit the job and go all in on the business? There's no right answer. It depends on your risk tolerance, your responsibilities, your opportunities. But here's what I know. The biggest growth usually happens when you fully commit. When it's a side hustle, you give it leftover time and energy. When it's your main thing, you give it everything. That focus and commitment usually leads to breakthrough results. Step 3 is scaling. Once you have a business that works, how do you grow it? Usually this means hiring people, building systems, investing in marketing, expanding your offerings. This is where leverage really comes into play. You're no longer doing everything yourself. You're building a machine that generates value while you focus on strategy and growth. Step 4 is diversification. Once you have one successful business or income stream, you start building others. You invest in different asset classes, real estate, stocks, other businesses. You spread your wealth across multiple sources. This protects you from catastrophic loss in any one area, and it compounds your wealth faster because you have multiple engines running at once. Step 5 is legacy. At this point, you're truly wealthy. You have more money than you need for your lifestyle. Now the question becomes, what do you do with it? How do you use it to make an impact? How do you pass it on to the next generation? How do you contribute to causes you care about? This is the path. It takes years, usually decades, but each step builds on the previous one, and each step gives you more freedom, more options, more control over your life. Part 2. Scaling your investments. Let's talk specifically about how to scale your investment portfolio as you build wealth. When you're just starting out with a few $1,000s, you're probably investing in index funds or maybe a few individual stocks. That's fine. That's appropriate for that stage. As your capital grows into the tens of thousands, you have more options. You might start looking at real estate, maybe a rental property or two, maybe REITs if you don't want to deal with actual properties. You might explore different sectors, technology, healthcare, energy, international markets. You're diversifying but still keeping things relatively simple. As you move into the hundreds of thousands, you're probably building a real estate portfolio. Multiple properties, maybe commercial real estate. Maybe you're investing in syndications where you pool money with other investors for larger deals. You might start looking at alternative investments, private equity, hedge funds, venture capital, angel investing in startups. These typically require being an accredited investor, which means having a certain net worth or income level. Once you're in the millions, your investment strategy becomes more sophisticated. You probably have a team helping you, a financial advisor, a CPA, an attorney, a property manager. You're thinking about estate planning, asset protection, tax optimization across your entire portfolio. You might set up trusts or other legal structures. You're also probably investing in opportunities that aren't available to regular investors. Private deals, real estate development, businesses that need capital partners. The point is this: your investment strategy evolves as you build wealth. What works at $10,000 doesn't work at $10 million. You need to continuously educate yourself and adapt your approach. Part 3. Building real freedom. Here's what most people get wrong about wealth. They think it's about having expensive things, big house, nice cars, designer clothes, fancy vacations. That's not wealth, that's consumption. And consumption actually keeps you from building real wealth because every dollar you spend on consumption is a dollar you can't invest. Real wealth is freedom. Let me break down what I mean. Financial freedom means your assets generate enough passive income to cover your expenses. You don't have to work for money anymore. You work because you want to, not because you have to. Time freedom means you control your schedule. You decide what to do with your day. Nobody tells you when to show up or when you can leave. Location freedom means you can live where you want or travel when you want. You're not tied to a specific place because of a job. Relationship freedom means you can spend time with the people you care about. You're not missing your kid's childhood because you're working 60-hour weeks. Purpose freedom means you can pursue work that's meaningful to you, even if it doesn't pay well, because you don't need the money. This is what you're building toward, not a Lamborghini. Freedom. And here's the beautiful thing. Once you have freedom, you realize you don't need or want most of the expensive stuff anyway. The people who drive Lamborghinis are usually trying to prove something. The people who have real wealth don't need to prove anything. You might still choose to have nice things, but it's a choice, not a need. And that makes all the difference. The path to freedom isn't complicated. Spend less than you earn. Invest the difference in assets that generate income. Reinvest that income into more assets. Do this consistently for years. Eventually, your assets produce enough income that you don't need a job anymore. That's freedom. That's wealth. That's what school never taught you was possible. Chapter 10. The New Rules. Part 1. Rewriting Your Story, K. We've covered a lot. We've talked about how the system failed us, how the education system prepared us to be employees, not owners, how straight-A students often end up working for C students. We've talked about financial literacy, assets versus liabilities, good debt versus bad debt, how taxes really work. We've talked about self-education, how to learn what you actually need to know, how to find mentors, how to take action instead of just consuming information. We've talked about advanced strategies, leverage, tax optimization, using debt as a tool. We've talked about the path to real wealth and real freedom. Now comes the hard part, actually doing it. Because here's the truth, most people who read this book or listen to this audiobook won't do anything different. They'll nod along, they'll agree with everything. They might even get excited about the possibilities, and then they'll go right back to their old patterns. Spending money on liabilities, staying in jobs they hate, complaining about the system but never taking responsibility for changing their situation. Don't be most people. You have a choice right now. You can close this book and go back to your life exactly as it was. Or you can decide that today is the day you start rewriting your story. That doesn't mean you have to quit your job tomorrow or make some huge dramatic change. It means you start taking small actions. Today. What's one thing you can do today to move toward financial freedom? Not tomorrow. Not next week. Today. Maybe it's opening a brokerage account. Maybe it's reading the first chapter of one of the books I recommended. Maybe it's cutting one subscription you don't use and deciding to invest that money instead. Maybe it's having a conversation with your partner about your financial goals. Maybe it's calculating your actual net worth for the first time. Maybe it's reaching out to someone who's successful and offering to help them with something. One action today, then one action tomorrow, then one action the next day. Small actions, repeated consistently, create massive change over time. Part 2. The Resistance. Let me warn you about something. As soon as you start making changes, you're going to face resistance from everywhere. Your friends might make fun of you for being cheap when you stop going out as much because you're investing that money instead. Your family might worry about you taking risks when you start a business or invest in real estate. Your coworkers might resent you for talking about investments and side hustles when they're just trying to get through the workday. Society will tell you that you're being greedy or selfish for wanting to build wealth, and the loudest resistance will come from inside your own head. The voice that says you're not smart enough, you don't know enough, you're too old or too young, you'll probably fail, so why even try? All of this is normal. This is what happens when you try to do something different from what everyone else is doing. The people around you aren't trying to hurt you. They're trying to keep you safe. And in their minds, safe means doing what everyone else does, getting a normal job, living a normal life, not taking chances. But you know what's really risky? Spending 40 years in a job you hate, saving nothing, retiring broke, and realizing you wasted your life making someone else rich. That's risky. Building wealth? That's the safe choice. You're taking control of your financial future instead of hoping someone else takes care of you. When you face resistance, remember why you're doing this. Remember what freedom feels like. Remember that you're playing a different game now, with different rules and different outcomes. And remember that the discomfort of change is temporary. The discomfort of staying stuck lasts forever. Part 3. Your move. So here we are, the end of this book, but hopefully the beginning of something new for you. I want you to understand something. Everything I've shared with you in this book is available to everyone. The information is out there. The opportunities are out there. The path is clear. The only question is whether you'll walk it. Most people won't. They'll make excuses. They'll say they don't have time or money or knowledge or luck. They'll blame the system, their parents, their circumstances, their education, and they'll be right. The system did fail them. Their education didn't prepare them for financial success. They did start from behind. But blame doesn't build wealth. Excuses don't create freedom. Complaining doesn't change anything. Action changes everything. You don't need permission to start building wealth. You don't need a degree or a credential or someone telling you you're ready. You just need to start. Start small if you have to. Start scared if you have to. Start with almost no money if you have to. But start. Open that investment account. Read that book. Start that side business. Cut those expenses. Have that conversation. Make that plan. Take one step, then another, then another. And remember this: the education system prepared you to be an employee. But you don't have to stay an employee. You can become an owner, an investor, an entrepreneur, someone who builds wealth instead of trading time for money. The straight A students don't have to work for the C students, unless they choose to. You're holding the map now. You know the game. You understand the rules. The question is, will you play? I hope you will, not just for yourself, but for your family, for your kids or future kids, so they don't have to learn these lessons the hard way like we did. For your community, for everyone who's been told the same lies and sold the same scam. The academic system failed us. But we don't have to fail ourselves. This is the end of the academic scam. Why straight A students work for C student investors. If this book made you angry, good. Use that anger as fuel. Channel it into action. If this book opened your eyes, good. Now keep them open. Keep learning. Keep questioning. Keep growing. If this book inspired you, good. Now go inspire others by actually doing something with what you've learned. The world doesn't need more people who know what to do. It needs more people who actually do it. Be someone who does it. Thank you for listening. Now go build something.